All right. So, good evening, everyone, and sorry for the delay. Since this is our first week of the class, I'm trying to be very understanding as possible with almost everybody so we can have a convenient time where we can at least get the majority of the class. So, out of 8 persons or 7 persons, we are having four, so that's a majority number. But so I can also be cleared that from next class, if we agree on 7 p.m., 7 p.m. will be the start date. I will not be giving extra minutes or hour of grace so that we can all take note of what's happening. So, quickly, let me share this guy. Can you see my screen as of now? Okay. All right. So, great. Let me clear this guy. Let me give a recap of what we did last. Okay. All right. So last week we were able to run an intro to what foreign exchange is about, and we started with the module one of the course training, which was introduction and definitions of jargons. Hello, if you can still hear me, can you indicate? Let me be sure. All right. So fantastic. So today we'll still be diving on the introduction and definitions of jargons. If you were able to write down last week, we had definitions of some certain jargons or terminologies used in foreign exchange trading. One of those we talked about was the commodities that are traded in the market. We also spoke about short and long, bullish and bearish, currency pairs. We discussed about base currency, quote currency, broker. How do we distinguish broker? What is a broker? I think that was one of the things that was required of us in our assignment. We equally talked about leverage, what leverage is, bid and ask price, exchange rate, margin, lot sizes, spread, and other ones. So today we'll be looking at the rest of the terminologies. One of those terminology we'll be talking about is what we call the resistance and the support. All right, resistance, support. We talked about quote currency last week. So we talked about position. What does it mean to take position in the market? Because you hear it often, as we say. We also talk about market orders. We talk about volatility, all right, and liquidity. We discuss on trading sessions. What are trading sessions? Then we talk on slippage and PIP. So we start with resistance. So, like I mentioned before now, over the assignment, I asked us to make a brief research on how brokers make money in the market. And I also gave us to define what swap and commission rates are. And lastly, what we had was for us to list about 10, maybe five brokers that we are familiar with. And I must say that the turnover for the assignment was very encouraging. Everybody did very well, and I must say it's great. But I also want to add that I think one of us was actually not aligned to forex brokers, because the brokers you listed out were not forex brokers. All right. So it's more like I think my response was you should redo the number three. So I know you're here. Please just take note. But overall, the report we got in was good, and I trust that we now understand what it means. Why I asked us to go find out how brokers make money, so you do not feel like brokers are prophets or they are messiah that just coming to stand between you and the market. You understand that being a broker or being a brokerage firm, you're actually doing business. You get, so brokers are doing business basically. So their business more like One of their business means of earnings, their approach to earnings or sources of income is through the responses you give. So many people mentioned swap charges. So many people mentioned commission charges. Some mentioned spread charges. All of those are entirely very correct. You get brokers have so many ways of earning, and we'll still talk about slippage. Slippage is another way broker make money illegally from traders in the market. So we'll talk about that along the line. So here we have on our screen is what we call charts. All right. So this is trading view. When we get to the softwares, we'll look into this trading view fully. What trading view does is trading view gives you a chart analysis or a chart representation of what is happening in the real world market. So it's more like represented in candlesticks. You have two different colors. One is for the buy, one is for the sell. Ignore my color, this is customized, all right? So I'm going to explain all of this interface to you when we start when we dive into trading softwares. All right, that should be in module 3 of the course. So but before then, I want to use this illustration to define some terms, although I'll still come back to these two terms. I want to start using this illustration when we get to technical analysis, that's TA properly. So I want us to talk about support and resistance. Now see support as there's one I want to use a scenario to define these two terms. You are in a building, you are in your house, all right. Now you are standing on something which constitutes the floor of the ground. Now that floor of the ground that you are standing on, that allows you not to fall, that gives you that balance where you are based on, you're standing on, that forms your support. All right. So if you are standing on a floor right now, or you're sitting on a floor, or you are lying down on a bed, as at where you are is your support. All right. So anytime you hear support, support is actually that region, that zone underneath where so many candles are resting upon. So you can write it down. Let me show you an example. I want to be very practical. So this is, let me say this point. If you can see my screen, all right, let me project clear. So if you can see my screen as it stands now, I'll explain this better. I just want us to get the terms clear. All right, when we get to technical analysis, I'll tell you how we use this to analyze the market. They just get the terms clear. All right. So support is actually that basement. This is the candles. They are lying down on an axis. So these points forms a support for them. You can see now I am currently, let me mark this zone for use. Let me use this zone for use. All right. All right. Currently I am on a daily time frame. If I should narrow down, all right. Sorry, please. I want to be very, very practical as possible. So I don't just speak theory. I don't want to be speaking theory only. Okay. Let's go to 4 hours. Alright. Okay. So this is it. Alright. So I think this illustration does the magic. Okay. So like I explained, when you say support the market, it actually means that place you are resting on, that place the candles are resting upon. Like I mentioned, we are using your house, your inside, the inside of your building, your house, your room as an illustration. You are inside your room and you are lying down on a bed. Lying down on that bed, your bed becomes your support. It is something that is trying to help you from falling down. All right. Now, if you are standing on a floor, the floor forms the basis of your support. That is a determining factor that helps you not to fall. underneath. All right. It is a solid foundation that helps you not to break underneath. So it's a solid structure that stops you from falling. So that's support. Now, what is resistance? Still assume that you are still in your room. The roof that is over your head is a resistance because it resists the rays of the sun from hitting directly to your skin. It resists the rain from soaking you inside of your room. I don't know if you get the illustration. So you are inside a room, the roof above your head is your resistance. Now the floor underneath your feet is your support. So just get those illustrations right so that you can apply them in the market when you see it. So this is in the market in the chart, as you can see my screen. This is down, this is up. This is how the candles are. So if I should ask now, where is the support? I've highlighted the support. This is the region whereby it is a region that has been noted whereby the candles did not fall. That means there is something within this point that is holding this candle from falling. You get beyond this point. So this is a support. Now a resistance is also the inverse of this point, whereby this is it. At this point, you hear traders say on this day, if you check the date now, this is Tuesday, 5th of December up till February 2024, Friday. There is a resistance at this point. GBP USD was unable to break this point. You get. So that means there is a resistance at this point that is stopping this market from going above. You get. That is stopping it from going higher than. When you are in your room, the highest point you can go is your roof. So provided you are in your room, it takes supernatural strength for you to break past your roof because there's a lot of things that is above that roof that will stop you from going above it. I don't know if you get. But if you check the foot where you are standing on, it is difficult for you also to break through where you are standing on the ground level where you are because the floor forms the basis for your support. It helps you from falling. Support helps you from falling. Resistance prevents things from hitting you. I don't know if you get. So in the market terminologies, we call them support and resistance. Just understand to that point. When we start trading, I'll show you how we analyze it into TA. So the next thing we'll talk about is just take notes, is what we call position. Now, position in the market, I don't know. Can you still hear me? Let me use text to write. So this is all right. So this is resistance. All right. So here we have the support. Okay. So let me differentiate the colors so we all know that okay this works. All right. So we have a support zone here. We have a resistance zone here. All great. So it looks better now. Now as it is now in the market, as you can find, I don't know if it's clear. Let me make it bold. So for those that will be watching this later can understand. I will say, all right, so it's beautiful now. Okay, so moving forward, the next thing we want to talk about is position. What is position? Position is actually a place in the market where a trader decides to make an entry. I don't know if you get. Is that very spot in the market? For example, now, let me say I'm going to Watts Market. Let me use Watts Market for instance. I'm going to Watts Market and I want to get a pair of shoes. When I get to Watts Market, I'm going to first thing that's going to happen is that I'll be roaming around the market, the entire market, to look for maybe a place that sells it cheap or a place that sells the quality I want. Provided I'm still roaming around that market, I have not taken a position yet. Where I take a position is when I decide to make payments for that shoe. So maybe I went to shop A, Mr. Emeka's shop. I left Mr. Emeka's shop. Mr. Emeka's shop did not have the shoe I want. Went to Miss Nkechi's shop. Nkechi's shop didn't have. I moved to Emma's shop. Emma's shop now had what I wanted. All right. Now at that point, I'm in Emma's shop. He has what I want, and I decide to make payment. We have an agreement, and I initiate a payment to buy. That is position. I don't know if you get. So now if I'm to use this trade now, this trading view to analyze or take position, mind you, we are going to look at this trading view properly. So at this point, let's assume this market is at this spot. This is it. And I decide, okay, that when the market gets sells into this candle, let me not use the terms yet. When the market sells into this candle, I want to make a sniper entry here, and I pick that entry here. Now, once that trade initiates and I take this buy entry at this point, I have taken a position at this point. So this is my position in case you are asked. It is the current position a trader makes an entry. Where you made an entry is called position, please. So we just take notes, all right? So let me illustrate as I did the other time. Where's my arrow? Um, okay, all right. So let me just write it out so you can see. All right, so at this point, this becomes my position. So let me enter text so you get to see. Great. I'm still defining the terminologies, all right? So moving on, the next thing we look at is what we call market orders. Market orders. So what are market orders? Now in the market, there are only two actions you can take whenever you open a chart. Whenever you open your MT4, MT5, there are only two things you can do. It's either you are buying or you are selling. There is nothing like make I wait, make I wait. If you are waiting, you are not doing anything. If you are analyzing, you are not still doing anything, because there are so many traders who are great analyzers. There was a time I was like that. You get, even subsequently when I'm psychologically um challenged in terms of so many consistent losses, because I do lose, I do win too, you get. So when I have so many losses at some point, I have this fear, fear of losing. FOMO comes in too. At times, fear of missing out plays to FOMO. So we'll look at all those factors later in the course. All right. So at that point, you are analyzing the market. You have not taken any order yet. You just dey like your friend is selling shoes. Every time you are going to price the shoe, you dey go price the shoe. You are pricing it, you're pricing it. You've never ever bought from a friend before. Anytime you see something nice, you price, you price. You've not actually placed an order. So market orders happens in two dimension, right? We have, it's either you are buying or you are selling. But when it comes to the MT4 and MT5, there are about four things you can do to set an order in the market. All right, can you hear me? There are four things. So you can write down the four one. So you can do a buy order. All right, a buy order is allowed. We have a sell order. This is it. Okay, let's go to, so if you're writing here, we have the buy order, we have the sell order. All right, please let me know if you are still with me so I'll not be too speedy. Hello, hello, can you hear me? I left the meeting. Hello. Can't see. Hello, can you still hear me? Hello. See my network. Stops my network. What's happening? Okay, it's browsing here now. Okay, I think I'm back. Yeah. Hello, can you hear me? Sorry, I'm connecting with two devices, so I wasn't speaking through my system. Yeah. All right, so great. So we have the buy order. All right. You can set a buy order, that's instant trading. You can set a sell order. All right. You can equally set a buy stop. All right. You can set a sell stop. Hello. Be sure that I'm okay. All right. Thank you very much for the reactions. I can see now. Okay. Sorry, I was looking at my screen instead of my phone. All right. So the four orders we have in the forex market, we have the buy orders, we have sell order, we have buy stop, we have sell stop. So I'm going to explain how you take those orders in the market. When we get to MT4, I'll still explain this again, or MT5. You find it on your MT4 and MT5. So this is it. Let's go to the current position of this market so I can explain properly. Here, this is where this market is at this point. All right. So I want to take a decision now. It's just like, let me see use the Watts illustration. I'm going to Watts now, and I've decided that okay, it is Mr. Emma's shop that I want to buy my shoe. All right. When I get to Mr. Emma's shop, there are two things involved. I can actually book Emma and tell Emma, do not sell this shoe for anybody. I'm going to make small payments to Emma, telling him to hold on to this shoe. That's not instrumental buying. That I'm going to come back in 3 days to buy this shoe. I have actually placed an order, even when I've not made payment. That's another way of placing order. All right. Or I can still tell Emma, all right, coming to his shop, there's this shoe is available. Yes. I don't want to buy this shoe at this point. Reasons being that I have not decided on which one to buy. Okay, if somebody buys this other shoe and it's only this one that is left, sell this one for me at this particular price. I still have made an order. Maybe I was having two choices, and because the two choices at that point they were in demand, so I can actually tell him, okay, since it's two of us that are rushing the shoes, sell for this guy first. If he takes at this price, if he buys it, then sell for me at this particular price. I don't know if you get. So I am buying that shoe with a condition that somebody buys something or buys the other one. So it happens in the market too. This is the real market. All right. So I can come to this point. I am a very busy person. I might be working 9 to 5, or I have another job that is giving me steady income stream, and I don't have the strength to look at this market for so long. So what happens? I can decide to place an order saying that with my MT4, I can command my MT4, my MT5, program it, and tell it that if this candlestick should buy up till this point, you get based on my analysis, oh yeah, start to sell. I don't know if you get. I have placed an order, but they've not started deducting from my equity yet, you get, because the market has not satisfied all the nested conditions. Until it's satisfied, then order has been placed. So I can tell somebody, if I can tell my MT5, if the market buys up till this point, start selling, start selling. That is called buy stop, or buy limit. You can hear buy stop, buy limit. Deriv has 6 orders, MT4 has 4. So you can hear buy stop, you have buy limit, you have sell stop. Either of the two, stops and limits are still orders. So if you get to this point, start selling downward. The same thing happens to the sell way. You can actually place here. Let me clear this guy, come back here and choose. a sell short position. Yeah. So I can come here and tell the market if it sells to this point, this market is here. But if the market starts selling down, you know what sell is? It's coming down. If it now sells to this point, oh yeah, make it start to the buy. So I can place the buy order from here, telling the market, oh yeah, since it's selling to this point, oh yeah, make her the buy till this target. I don't know if you get. So that is called, those are the four types of orders we have. We have the direct buy slash sell order, we have the buy slash sell limit. All right. So we have those two types available in the market. Now, another thing we talk about is the traders we have. I know a lot of you might be wondering, is everybody equal in the market? Is everybody trading the same thing in the market? There are various types of traders in the market. There are basically, we have four types of traders in the market. So you can write down, we have what we call the scalpers. This happens in real life. So as I'm explaining forex, I'm bringing it to real life commerce too. So you get to see it. So we have what we call the scalpers. We have what we call the swing, or we have the intraday traders. Let's leave swing. We have intraday traders. Then the third one we have, let me arrange in the order. We have swing traders. Swing traders. Write down. Then the fourth one we have is called the position traders. Now, just like life is, everybody's not equal. All right. In life now, we now have class in life. We have the high class, we have the middle class, and we have the low class. All right. These people are differentiated by what they possess, their possessions, their material possessions, or their intellectual value, what they offer to the society, or the positions they hold politically, anyhow it is, can determine a class of a person. The same thing applies to the market trading. Now, what makes some of us fail in trading is because we are unable to identify the type of trader we are. This was what ruined me when I went to you. Already, when we get to the experience, I'll share it better then. You get to understand. All right. So, oftentimes, we do not identify the type of traders we want to be or we are. But for you to be who you need to be, you first need to explore your strategies on demo. You need to explore it over time till you master it. You get into life, you start trying things out. Definitely, 1 month period, you're already steady if you are committed and faithful to what you are doing. You get. So, what am I saying in essence is that this market as it is now has four types of traders. And those traders are determined by what we call, if you see my cursor, can you see my screen? If you can see my cursor, this point, where we have this point, let me drop it down so you see, is a big factor that determines your type of trader. All right. This is called time frame. It's called time frame. Time frame is, I will explain all of this when we get to trading view. We start the software. The terminologies are different. Okay. So now this point you see here is what determines who is this type of trader, who is this type of trader. Time frame. Let me explain. Scalper, the first one I mentioned. These are traders that stay in the market, they take position or they place order in the market between a time frame of 1 second to 15 seconds. In fact, 15 to 15 minutes. 15 minutes is too long for them to be in a market for a particular trade. Let's say I'm taking this trade now and I'm here. I've decided to place an order now. So this trade is currently running as it stands now. Now this trade has not gotten to my TP yet. I decide to close the market. I just decide to close the market because it's up to 15 minutes. I don't have patience. These are impatient traders. What they do, they scalp. They wake up in the morning before the day close. They've made 30 trades. They've opened 30 positions already. Okay. But as it stands, they don't have the patience to hold on to this trade for longer than 15 minutes. Just understand me, okay? Now we now have the intraday traders. Intraday traders are those ones that take trading as a real life business. How is it like? You know, when you get to the what market, if you are selling, if you are a trader, you get to oil new market, any market at all you know of, all right? So if you get to the market or any business, if you're a business person, you always give account of your profits you've done, of the profit margin you've acquired at the close of the day. Now, these are what intra traders are. Their trades don't slip over. Broker can never enjoy what they call swap or commission rates from them. Broker no dey see their swap charges because they don't keep trade to slip over to the next day. All right. So these are those types of traders that they ensure that before the day close or the trade close for the day, they have taken their profit or they have taken their loss. They close the market and they sleep peacefully. Those are the types of traders that are called intraday. So they trade within the 24-hour calendar and they have a trading zone they stick to very faithfully. I don't know if you get. Now, moving on, we have the swing traders. Swing traders are people, these ones, they possess a good equity, right? Take note too. They have a good number of equity is a criteria. You don't need to come into swing trading with $10. You don't go into swing trading with $20 account. All right. 50 is considerable. All right. But it's a high risk game. So if you are going into swing trading, these are people that hold on to the market for as long as days. They hold on to it for between one full day or 2 days to as long as 1 month. These are swing traders. It doesn't exceed 1 month. You get, those are the type of trading they do. Now we now have the big ones. No retail trader does this. Only institutions, financial institute engage in this type of trading. They call them the position traders. You can write them down. I don't think Baby Pips has this, but just note. We have the position traders. These are how banks trade. These people hold their trading for years. Let me show you an example. If I'm coming in here to use technical analysis to analyze this market, I have no business with 15 minutes time zone. See what I've marked out. I've marked 1 minute, 3 minutes, 5 minutes, 15 minutes, 1 hour, 4 hours, daily, weekly, monthly for my technical analysis. But you see those guys, they do not have any business from 4 hours down. What they start analyzing, they are looking at the market at a very bigger picture. This is it. How they see the market, they see the market at a very big picture. This is 1 year, 12 months period. So this is how the market has behaved since the beginning of this year. Okay, this is 1972. Can you see? When this trading view open officially, this is just the candles you have. 1972. If you count the years, this is complete year till 2024. So if you check 2024, it's just one candle that represents 2024. You can find that, right? If you check 2023, you can see a short small candle. So everything that happened in the other sequence that you saw in the 4 hours is happening in this 2024. But this is how they analyze their market. So, however, they see the market is not how you and I see the market. So, it's different. That's why sometimes when I see people engage in um, copy trading, I just smile. I've tried copy trading before with IPC. It worked for my boss then, but it didn't work for me because my boss had a very good capital and the bot was trading very well for it. But it didn't work for me because I came in with a very small funds and I was feeling like I should be using the signal. Whereas I don't know how the person is analyzing. So the person gets into profit and I'm into loss, something of such. You get that point, right? So that's it for position traders. So position traders are those traders that hold their market for months. For months. They have peace of mind. They hold it for months. That's pure investment. That's how trading should have been with a leverage of 1:2. You get. So that's that for the types of traders. We are going to look at the next thing which we call TP. Take profit, stop loss and break even. Please, you can write them down. You have take profit, stop loss, and break even. Okay. Please, if you can hear me, can you drop a message or an emoji? Let me be sure. Okay. All right. Great. Okay. So we have what we call take profit in the market. What is take profit? Let's still use the illustration that happened at what. Let's still use the what illustration. I went to Mr. Emma's shop. I want to buy shoe. Okay. Now I'm going to the shop to get the shoe. We will start by negotiating. We will negotiate at the particular price. Now, if I bargain the cost price or the cost price of that shoe, Emma bought it was, let's say, 20,000 naira. And me, I'm the person that wants to buy that shoe. Going into that business to negotiate, I want to buy that shoe from him to take a position. I'll tell him, okay, this shoe I want to buy it at 18,000 naira. Now, if a man sees that, okay, this shoe has been in my shop for the past 3 months, I've not sold it out, a man can decide to take loss. He can decide to sell that shoe at a loss. At least let the shoe be out of his shop. Some people believe that if product is in a shop for too long, it causes stagnation. So they would rather sell it at a lost price. You get? So that's what they call SL. I am contented that, okay, if I don't make sales here, no matter how bad the market goes against me, this should be my stop loss. You are programming the system now. Okay, this is it. It is stop loss is an appetite that it is your risk appetite. Let me use that word. Stop loss is your risk appetite. That place where you are satisfied, you are okay, you are aware that if the market should go down below, I am okay with so amount of loss. I'm going to show you the calculation. There's a small calculation accompanied with this. So I'll show you as we move on. All right. So if the market goes down, 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 I want to lose. I no wan pass this point for my loss. Let me take out this guy so I don't confuse you. Let me use this. All right. Let's assume, okay, I want to take a trade from here. Now I want to enter a buy trade at this point. I want to set my stop loss. I can do my calculation. Once I do my calculation and I've decided on the amount I'm going to risk in this market, I can say, okay, this point, this tip, once the market gets to this point, it should kick me out even if I'm losing. All right, because the market, there are two buyers. It's either you are winning or you are losing. So this is it. But it's not a gamble. If you understand the business, you know. All right, so this is it. I decide to take a buy entry here. Let's say I want to buy GBP USD. Now, if I'm making my entry at this point, I decide that, okay, this place should be my stop loss. If the market should invariably start selling downwards, downwards, downward, once it hits this point, it takes me out. Because if it does not take you out, it keeps going, it is penetrating your entire account until it finish and wipe out your account. It's not going to stop. It will keep going. Even if it wipes you out, it's still going to another direction. So using stop loss is a determining factor for your risk management too. You get? Now, if you can also tell the market that, okay, if the market buys up to this point based on my analysis, you get, the market reaches this point, I should take my profit. I am satisfied. I'm not too greedy. Once it gets to this point, I should take my profit. What are the reasons? This market can buy. If it did not set TP, this market can buy past this point and still be buying. But because you have not set a TP that if it gets here, it takes you out with the profit. You can buy once it pass this point, you can now start selling back inside and take back all the profit and out. So there's a likelihood, a high chance that that happens, and it happens frequently. So you need to always use TP. TP is where you take profit. SL is where you stop loss. Just like, let me use the instance again for take profit. The price of the shoe Mr. Emma bought it was 20,000 naira. Now he wants to sell it. He will assume that if somebody bargains this price, I'm going to place a higher amount, expected amount. Let me say I want to sell it at a profit of 7,000 naira. That means I'm selling the shoe at 27,000 naira. You get? But I can decide that, okay, if someone actually priced me up to 24,000 naira, let me sell it out so that I don't miss out on this customer. You get? So maybe someone came in and bargained 22,000. He never reached that 27,000, but you still be like, okay, 22, you still negotiate. 23, you negotiate. Once the person reaches 24, you call him, Oga, come, ma sell and give you. That is his TP. That is his take profit. You get? So this is, at this point, this is your SL. He has decided that, okay, no matter how you want to cheat him, 2,000 naira should be his loss. That is a decision of his own. You get? So that's TP stop loss. Let me label it so you get. So you have take profits. When we get to MT4, I'll still come back to this definition. Sorry. Um, Stop loss. So, okay, so take profit, stop loss. So that's that. Let's move to the next term. Are we understanding? If you have a question, please ask. Let's be sure. If there's a question, let's ask. All right. So I think we are still together. So I progress. So the next thing we talk about is what we call volatility. Volatility. Please, just your emoji once again. Let me be sure that we are in tandem. All right. Fantastic. So the next thing we are going to discuss is what we call volatility. Okay, Ruben, your hand is raised. You would like to speak here? You can unmute and speak. Hello there. All right. Okay, that's fine. I'll call you shortly. I'm in a meeting. No call. Yeah. All right. Thanks. Hello, can you still hear me? Okay, I can still be heard. Yeah. So the next thing we are going to look at is volatility. All right. So volatility. So what is volatility? The word volatility. What does this mean? All right. So let's come here. Let me write it out. So volatility, when they say volatility, let me use an instance now. When it comes to the meat market, I'm using an instance now, meat market, and you have a slaughter in the market. This is a real life illustration. The market has a slaughter. You agree with me that there is a particular time, there's a particular time, or let me not use that illustration. Mm, okay, let's say there's a particular market. Let's use an instance, Watts market or Marian market. Now there are two types of markets now I'm calling Watts market, Marian market. You agree with me? Okay, we have beach markets too. You agree with me that when it comes to Sundays in that city, none of those other two markets beats beach market because beach market actually owns Sunday. So if you want to see the highest number of traders in that market or how busy the orders are in that market, is always on Sundays. I don't know if you get. So I want to define two terms at the same time. So let me go ahead and define these two terms so you know the differences. The word volatility, let me use the term. I don't want so that tomorrow you'll not use it against me and be like, okay, this was how we defined it and this is how it is. Volatility. in trading means. All right. So, okay, volatility is an investment term that describes when a market or security experiences periods of unpredictable and sometimes sharp and price movement. Watch, read the definition. It is when a market experiences periods of unpredictable and sometimes sharp and price movement. That means it is a time whereby, sorry, it is a time whereby the market experiences sharp movement. Sometimes the market experiences an unpredictable, you cannot predict it. It makes the market dangerous. It makes the market very dangerous, which means that it's a time in that market, for instance, I'm trading GBP USD. There's a time in the market that I can make very high amount of money. The market is very volatile. There are some pairs in the market. Let me open some to show you. Gold is one of those pairs. You don't joke with gold, trading gold. People who trade gold can testify. Now, you don't joke when trading gold. I used to trade gold, but gold made me a lot of money. Gold still took a lot of money from me, but I'm still on it though. So this is gold. Now, this gold you see here, a particular movement of any of this candle can make you so much and can take so much from you. This is 5 minutes. The way this market moves is very rational, is very rational. It can make you so much and can take so much from you. Just a particular movement of this tick can make you a lot and can take a lot from you, which means that this very market is very volatile, very volatile. You cannot go to on a Sundays, beach markets on Sundays have high liquidity. I'll come to liquidity. But on that Sunday, if you go to Marian market, Marian market is unpredictable on a Sunday because there is scarcity of traders, people that are actually trading in that market. All right. Okay, there's a message. Okay. So there is scarcity of people that are actually trading in that market, and because there is scarcity of people trading, they want to take their price very high. You can either go and buy cheaply or you buy at a very high rate. That makes the market very volatile. Now, when it comes to liquidity, the term liquidity, let me still use the illustration. I'll still define this. Uh, I like to be very literal. Okay. How rapidly shares of a stock can be bought or sold without substantially impacting the stock price. How fast can it be sold? Let me use an instance. Now, that illustration I wanted to use. If I go to Watts Market, where they do slaughter, where they slaughter goods, you agree with me that there's a particular time that you will sell meat. If you go to the afternoon around 1 p.m. to go and buy meat at a slaughter, you might likely not buy the best, and meat, you might go there and you might not find meat. But when you go there 6 a.m. in the morning, you are very sure you get a high influx of people, provided they are done, or maybe 10 a.m. There are some market that sets their structure to 10 a.m. So there's a particular time where there is high influx of traders in the market, very massive. Everybody is placing an order. It happens like that. That is called liquidity. And when you look at this in candles, liquidities are always represented by, when we look at candlesticks, you find it. This is an ICT term. We don't play with liquidity when it comes to uh, institutional trading. It's something we hold dear. It's something we hold so dearly in the market. So all of these stuffs is an evidence that the market at that point was experiencing a turbulence liquidity. It happens when there is a news breakout. You find it often when there is a news breakout, fundamentals in the market. So So all of these stuffs are called wicks in candles. Wicks. All of these stuffs are called wicks in the market. Someone join. Okay, kindness is back. So all of these stuffs are called wicks in candles. You know, candles have wicks. This is where that is burning, the part that is burning. Then this is the main candle. It burns till it burns out. So this is like a normal candlestick. We'll look at candlestick. Alright, I think it's one of the definitions here. We have to touch, we have to talk about. Let me see. Here is the third one. After we look at software, we look at candlestick patterns. So we talk about candlesticks. So this candlestick shows you that there's high liquidity here. That means when this market sold, there were so many presence of buyers and sellers. So because the buyers are more than the sellers, it was able to push this market from this point to this point. That means there were so many buyers here. People are placing their entries around this point very rationally, as at this time plenty traders, millions of traders have executed this trade at this point. All right. So this is a representation of liquidity. Going to what market by 12 o'clock and you feel like you are going to buy meat, you might end up buying rubbish that is spoiled. All right. Or going there as early as possible to a slaughter, like where they kill the cow, or whether it's goat slaughter, however it is. When you get at that point, you are rest assured that you are going to buy meat, because you go there and meet people. You might even find a very long queue. That is liquidity. It is the number of, when there is a contest in the market, that's liquidity. While volatility is that unpredictable circumstance that occurs in the market. That period, it can make you or mar you. All right. So volatility is trying to explain the danger that is associated with the market, or the rewards that is associated with the market. So the next thing we look at is what we call RRR, risk to reward ratio. I'm trying to get as define as many terms, because from next module I'll be speaking with a lot of these terms. I think 2 to 3 classes will be familiar with most of these terminologies. So let's not be carried away. So this is a risk slash reward ratio. I call it RRR. This is actually like a ratio of proportionality that shows the risks you take and the reward you are expected to get. You see, it's represented here. This is a 1 is to 5.62 ratio. So it's always anything you see here, just know that is 1 is to this, 1 is to this. So like this now, this is the ratio of this trade. This is a 1 is to 3.87 ratio. I take it up again. You can see it's more like, you see my stop loss is gray, my TP is light green. So this is like half, almost half. So if I take it half, you find it is 1 is to 2. This is half of it. Okay, 1 is to 1 is half. When it's half now, it's 1 is to 1. I don't know if you get the math. So math students can analyze. So if I place it at 1, this is it. This is half of this. So it's actually ratio and it's 1 is to 1. So my risk, that means I'm bringing $5 to make $5 chicken now. So if I'm staking $5, that means at the end of this trade, if it goes in my profit, I should be able to make $10. I don't know if you get the math. Just like you are doing open betting with your friend. Man U will win, Arsenal will win. So the match has started. You guys bet 5,000. That is a 1 is to 1 ratio. Nobody's bringing much money than the other. I don't know if you get. I'm using predictions as sentimental predictions, for instance. So if I should take it down by 2, that means this guy is bringing 2.5 thousand 500 naira. This guy is bringing, the reward here is times 2 of this guy. I don't know if you get. So that's what risk to reward is. All right. So that means I'm the end. I'm making 7 point something dollar from this trade. That's what this actually means. So risk to reward is the amount I'm risking equates the profit I'm getting. So there's a calculation associated with this. We are going to look at that calculation after I exhaust pips. All right. So we go to the next definition. We have we have trading sessions. What are trading sessions? Very, very important that traders should know. So let me open this. So it gets, let's go to baby pips, because the first pop will be baby pips. This is it. There are four types of trading sessions. All right. But I want us to get the sessions right. There are four types of trading sessions. So can you still see my screen? So for those that want to be busy, to refresh their brain, make research, you can come to Baby Pips, create an account. It's free just to read all of these stuff, just so that you can know, or to verify if I'm lying or I'm saying the truth. If I'm lying, next class, please come and challenge. All right. So let's keep going. You can get it very interesting. So this is Baby Pips now. Baby Pips here says that there are four types of trading zones, which we totally agree. There are four trading zones. We have the London session, all right. We have the Tokyo session, we have Sydney session, we have New York session, all right. We have London, we have New York. London is UK, New York is US, Tokyo is Japan, Sydney, I think Sydney is still Japan, or more so, but it's more like an interior Asia or something like that. Or Sydney, they have their flag here. Let's see, just to be sure, please. Australia, yeah, correct. Yeah, thank you, Master. Yeah, Master Econ. So we have Sydney, Australia. There's a flag here. We have Tokyo. We have UK. We have US here. So these are the four covers of the the trading sessions. You can see their time zone -4, this UTC. So -4 of our time zone, +1 of our time zone, +9, +10. All right. So I'll share a calculations I once did when I was trading. Because when it comes to ICT trading, we stick to sessions. All right. I trade the New York session strictly. So -4. If you find my trading view, this is +1. All right. But if I should switch this, we switch it to New York direct. So automatically, if I'm to structure this timing now, everything here is followed by New York. So I obey the, I'm trying to stick to ICT policy, right? Trying to obey the midday opening and other terminologies we look at later on. So that is what you need to note. Trading sessions. We have New York trading sessions, we have London trading sessions, we have Sydney, and we have Tokyo. All right. So let's see trading sessions in Forex. All right. So this is it. Sydney opens 7 a.m. Sydney closes 4 p.m. This is using the GMT. Now, Tokyo opens. Let me open this so you see. I'm still here again. I want to get straight to the table. Okay, this is it. Yeah, this EST UTC. Correct. So we stick to UTC. So Sydney opens local time. These are local time. So +1 now. If you are using the Nigeria or Lagos time zone, this is going to be 10 p.m. every night. Sydney opens. Sydney closes 7 a.m. every night because we are +1. All right. Now Tokyo opens 1 a.m. our time zone every night, every early morning, and closes 10 a.m. every early hours of the day. London session. London session opens 8 a.m. every morning. This is our time zone. Closes 5 p.m. of our time zone. All right, absolute. The same thing here. New York session 2 p.m. 2 p.m. afternoon and closes 11 p.m. at night. All right, so we'll look at the sessions clearly when we start ICT trading. For those that want to advance into getting the technicals of ICT, but trust me, as a retail trader, you can still make a lot of money because trading is 60% psychology. Don't allow someone to whine you. 30%, in fact 20% or 25% risk management. It's just, let me just say, 5% strategy is what you need in trading. You just need 5% of the strategy. The rest of the percentage, 20%, goes for your equity because you need money to trade. Alright. So if you have 60% psychology, you have 20% risk management, 5% strategy, 20%. Trust me, you'll be very, very consistent. So I'm going to share along the line. I think my next class I'll be prompted to share my story. So I'll hold on to what I said to encourage you guys to. So back to our definitions. The next thing now we look at is slippage. What is slippage? Now when you talk about slippage in the market, let's go to the market. When you talk about slippage in the market, this is an unforeseen occurrence. Sometimes it is triggered by selfish brokers so that you can make money. I'm not supposed to bring this. They will not tell you most of this, especially slippage, because they feel it's not important. It is important you understand. So slippage is that thing that happens in the market whereby your market has not hit your SL, but the broker is going to close you out because he's seeing a chance that okay, you're going to make a lot of money. It happens in the market. When there is too much frequency in slippage, a trader is advised to change his broker. That is the real truth. Don't stick to that brokers. I will not want to spoil certain businesses, but at the end of the course or towards the middle of the course, I can recommend some good brokers you can stick to. But some of the brokers you all know have problems with slippage. You are going to experience it when you start trading. Not that your analysis was wrong, but because the broker has observed, okay, that if you pull out up to this point, there is going to be some funds. So there's a high chance that the system, sometimes the technical glitch, alters the empty fall to kick you out of the market. It's called slippage. All right. Sometimes the systems kick you into massive profit. It's still called slippage. All right. So it happens in the market once in a while. It seldom happens. But at times when you did not expect it, you might experience it. All right. So that's what we call slippage. So we go to the last part of what I'll be defining. I decided to drop this for the last. It's called PIP. PIP. I call it the morning factor of Forex. Everything we are doing in Forex revolves around PIP. PIP. What does this mean? Percentage in profit or profit in percentage, however you call it. Percentage in profit or profit in percentage. Let me write it because it's a big one. Is this guy? Alright, so percentage in profit. Where's the arrow? Where's my arrow? Sorry, is there any need to write it? I don't want it to be clear. So we are all clear. Sorry, I like to, yeah, nobody said you not see it. Everybody's seeing it now. Okay, so we have percentage in profits. so you all can see. Sorry, taking over. Okay, so this is it. So everybody can see it's clear. So this is percentage in profit. What does it actually mean? So we get to this guy. If you can see my screen, percentage in profit connotes, you see these values you are seeing on the right hand side, these stocks you are seeing, this numbering you are seeing on the right hand side. This is called the peak value. This is called peak value. These are the radars, the current position. Now if I'm supposed to pick my entry here, okay, let me use this very trade. Let's see what it has got. So for instance, this is a trade. I want to take a sell entry at this point. Let me use sell for instance. Okay. So let me use sell for instance. I want to short this market from here. Now my profit is determined in pips. What I'm making from this market as at that point is determined in pip value, not in any other thing. It's pip value. How? From this point to this point, if I place my cursor here, TradingView will be able to tell me the pip value of what I'm expecting to make from this market. Alright, as it stands, you see this place the right target. So you see this target, you can see 23. Is my screen clear? Let me maximize. Is it better now? Can you see? Can you see my screen? Is it better? I think we're not seeing before. So this is it. Alright, so good. So now this is it. If I should if I should want to check the pip, what is the pip value of this buy trade? This is 23.181. These are the numbers we use for the calculation. So if I'm to take an entry here, I'm supposed to make 23.181 as my profit. I don't know if you get. So if I'm expecting a profit here, 23.181 in pip is the profit. So the calculation we are going to be doing is to convert this pip value to dollar equivalent. That's the calculation I'll be showing you. Alright. Now you come here, this is the loss, the stop loss. If I'm supposed to lose, how much am I losing in pip value? 4.893 in pip value. Alright. So take this down, write this down. 10 pips makes $1. Can you hear me? Said my microphone is noisy. Okay, great. Yeah. So 10 pips makes $1. I think after this calculation, I'll pause for questions. 10 pips makes $1. All right. 100 pips. If 10 pips make $1, 100 pips will make how much? $10. I'll explain how we get it. That's how I calculate it so I know my risk before initiating any trade. So this is it. 10 pips makes $1. That means if this market should move, if this market should move 10 pip, all right, I'm making $1. That's default calculation. Pips makes $1. What triggers this stuff is your lot size. By default, if this market should move 10 pips as it is now, if not for my lot size going to determine how much I'm losing, automatically I'm supposed to lose 0.489 cents in this market automatically because this is 4p. So if it's making $1, that means this is divided by 10, 0.4. I don't know if you get. Please, if you need me to repeat, I can repeat. That means by default, I'm supposed to be making zero. I'm supposed to be losing if this market should go against me. I'm supposed to lose 0.4 because you are going to divide this pip value by 10 to get the actual thing you need. This is it. This is okay. He said I should repeat. Let's go to the profit. By default, 10 pips makes $1. It therefore means that this is 23 pips. All right. Now, how much am I making from 23 pips? This is 23 divided by 10. Let me know my amount in dollar. This is because I'm not multiplying by my lot size yet. All right. Lot size is not a determining factor. Okay. So if I'm having 23 pip in value, it therefore means that by default, I'm supposed to make, that means I've not initiated this trade yet. I never know the lot size why they use. But if I'm supposed to choose a lot size will be multiplied by whatever I'm doing here. So if I'm doing 23 pips, this is 23 profits expected, 23.181 profit expected in pips. Let me see if you can see my calculator. Let me pop my calculator up so you can see it clear. Is my calculator visible on the screen? It's not. That would be the problem. It's not visible, okay. We can still use our calculator so that you can be doing the math alongside. I don't want to end since I'm recording, so I don't end everything, yeah. So this is it. If I'm supposed to calculate this is 23, okay. So this is 23.181 is my pip value for profit. The statement states that 10 pips, if this candle moves 10 times, moves 10 pips, it covers 10 pips. This currently, this candle moving from here, or this candle is moving from this point to this point, my trading view has calculated and told me that is a total of 23.181 pip that has been covered in pip value. So if this has been covered 23.181 pip in pip value, how much is the dollar equivalent of this pip? That is the calculation we want to do. The math has told us 10 pips makes $1. So 23.18 pip will make how many dollars? 23.181 divided by 10. It's just a very simple calculation, not too much headache. It therefore means the amount in dollars is 2.3181. This is how we actually plan our risk management. All right. So 23, let me repeat again. 23.181 pip. 23.181 pip is equivalent to 2.3181 dollar. Let me elongate again. So now, if for instance we are having a pip value of 27, or let me make it 30. So if I'm having 30.5 or 30.425, how much am I supposed to make in dollars? That means the equivalent is 3 point something dollars. This is just a very simple math. Just divide this value by 10. All right, cheeky now. That's simple. That's very simple. I don't know if you get. Just hold this very one at your tip. Just hold it at your fingertips. Okay, let me use a real life illustration so you understand. Okay. Ruben has Ruben, for instance, you have let's say you have 30 bags. All right. You have 30 bags as a person, or 30. Okay, you have, let me use money because money will be easy to calculate. You have 30,000 naira as a person, and I'm giving you this 30,000 naira. I tell you that for every 2,000 naira that you are holding, say 2k, if 2,000 naira is supposed to be for one child, that means you are supposed to give 2,000 naira to a particular child. Now, how many children are you going to give that money so that this 30,000 naira will finish? How many children are you supposed to give the 30K to exhaust 30K? That would be 30,000 divided by 2,000. That's how you calculate it. It's just money maths. It's as simple as that. That means you have a total of 15 children to give 30,000. You can share 30,000 naira conveniently, 2 2K, 2 2K, 2 2K across 15 children. It's as simple as it is. So the same thing applies here. I'm telling you that for every one person, give 10 pips. For every $1, give the person 10 pips. And now what you have at hand is 30.425. So how many persons or how many dollars will receive the 10 pips? Is 3.0425. Please, if you are cleared, before I move on, can someone write on the chat box? Let's be sure. So if you are okay with the explanation, can you indicate before I proceed? Hello, can someone hear me? Please. Okay, I'm seeing thumbs up from Prince. Okay, I guess kindness. Do you understand me, kindness? Let me be sure. Kindness, do you understand me? Let me take a break. What's this? Is it confusion or you need further explanation? Please let me be sure. Okay, I should repeat. Okay, thank you very much. So let me repeat again for the benefit of doubt. I'm having 30.425 as my peak value. All right, this is the target profit. All right, so I'm supposed to make in this trade 30.425 as peak value. Now, the statement or the law has stated that from calculation that for every 10 pip that this candlestick moves, the equivalent that is being structured by brokers is $1 equivalent. $1 is the equivalent structured by broker. So that means for every 10 pips that I make here, I'm getting $1. For every movement that this candle moves and covers 10 pips, I'm getting $1. $1 for every 10. Not that every one pip I'm making $1. No, every 10 pips makes $1. I don't know if you get. So because every 10 pips makes $1, this very trade, I'm expecting the total of 30.425 percentage in profit. That's pip. This is what my expectation is. 30.425 is what I'm expecting to make in this trade. So because I'm expecting to make 30.425, that means how much in dollar am I making? It's simple. It therefore means 30.425 divided by, therefore means 30.425, all right, divided by, oh sorry, divided by 10, and this will be equal to 3.0425 dollars. I don't know if you get. Do you now understand? Do you now understand the illustration? All right, so great. Kindness, do you understand? This is just okay. Kindness, speak, please. Yeah, please speak. Yeah, kindness, your hand is up. Please speak here. Let me unmute you. Hello, kindness. If you can hear me, please speak. Or is it a mistake? Kindness, please speak. Okay, so I think it was a mistake. Okay, alright, it's a mistake. He now understands us. So we proceed. So do we understand what pips are now? Pips is the percentage in profits, the equivalent you are making in dollar. It tells the money you are making in dollar is what pip is. So if you understand, let me write on. Let me continue. Okay, so the next thing we are going to look at is called lot size. That's the last thing for today. Then we'll close so I don't bore you too much. Then I'll give an assignment. Alright. The assignment will be based on the calculation we are going to be doing now plus the one we have done already. Alright. So I think we understand this simple calculation. So let's go on to lot sizes. Now, lot size, I already defined lot sizes, but I did not explain lot size as a thing clearly to you so you can understand. So what lot sizes I told you are, I said lot sizes is a determining factor for your risk management. Alright. Lot sizes is that number, the the purchasing power, your risk power. It is your risk power, your profit power, or your loss power. The risk power is your loss power. So it's lot size that determine how much you make in the market, whether you get rich or you get poor. Lot sizes is what determines whether you are going abroad or you are going to the village. Lot sizes is what determines whether you go to prison, you go to heaven, or you go to Dubai. So any of those three things, lot sizes is what determines it. So there are people that mistakenly, when their village people follow them, they mistakenly go and pick a wrong lot size. It ruins them. Not that they don't know what they are doing, but because their village people have attacked them and they want to use forex as evidence, they now choose the lot size for them. So lot size is a superpower. So now I want to define the type for that about there are three types of lot sizes, abi four, but for forex market there are three you need to note. One is what we call the micro lot size. Okay, let's look. We have the macro. Let's look at macro lot size. Please write down. We have macro lot size. We have micro lot size. We have standard lot size. This is for forex markets. But when you go to indices, this market, when you come to this synthetics market, you observe that the lot sizes are even more. All right, we have four of it. We have in this one we have what we call nano. Although in we have nano lot sizes, I will explain each of them and their differences. So we have nano, we have macro, we have micro, we have standard. I repeat again, we have nano, we have macro, we have micro, we have standard. So I'll write here. Permit me to write here again. So this is it. Let me use a good text. Man. Alright, so let me write here lot sizes. Great. So we go down. We have one. We have nano lot sizes. So what are nano lot sizes? Nano lot sizes are those sizes that has three decimal places and it starts from 0.001 and ranges it ends at 0.009. That's nano lot size. I want to give a very simple definition. What are macro lot sizes? All these ones are available in your MT4 and MT5. So there will be an assignment after this. So this one ranges from 0.01 and ends at 0.09. All right. So we have the third one. We have micro lot sizes. So this one ranges from 0.1, right, and ends at 0.9. All right. So we have the fourth one. We have standard lot sizes. Standard lot sizes. So these ones, they start from 1 and they go as far as 50, 90, depending on your broker. They just know whole numbers. These are whole numbers lot sizes. Whole numbers. All right. So did we get that right? So this is it. We have nano lot size 0.001, 0.009. Macro lot size 0.001, 0.009. Micro 0.1, 0.9. Standard 1 to 50. Simple. Shaking now, right? So I'm going to show you a very simple illustration so you understand what we're talking about. All right. So based on this calculation we have done now, that for every 10 pips, I want to show you two ways to calculate it. How to calculate your profit so that we can also look at how we can calculate our loss. We'll do this next class before we look at trading softwares. Where before now, I'll tell you the things you need to install now. So that next class they are coming with those things. We are defining each and every of these things you see on this screen, plus your trading software, the MT4, MT5. We'll start with MT4. As you move on in the middle of the class, I'll ask us to migrate to MT5. All right. Then we'll look at all of these tools clearly from next class. So now, lot size. Let me drag this guy here to this calculation. So there are two ways to calculate your profit. The small calculation I told you about. I've told you about this. 10 pips makes $1. Now, if you have an equivalent of 26 pip target, this 26.137, how many dollars are you making? That means you are making 2.6, $2.6137. That's your amount. Just like we have naira and kobo, dollar and cent. So 2.6137 cents is what you're making from this market. So moving forward, we have nano lot size. What determines this amount is that when you have your target, should I start this now? Or next class I'll just explain. Okay, let me not bore you. Understand to this point that we have four types of lot sizes: nano, macro, micro, standard lots. Now, understand that for every 10 pips is $1. For every 100 pips, $10. For every 1,000 pips, $100. Every 10,000 pips, $1,000. Like that, like that, like that. Just understand this part. For every 10 pips makes $1. So if you're having 26.137 as your pip value, that means the equivalent in dollar is 2.6137. Just understand to that point, because if I add this I might confuse us. So let's take a break. We are meeting again on Thursday. Yeah, we are meeting on Thursday again, so we'll have a class. What I'll do is, for our assignment, I'm going to share a screenshot of a trade, all right? And I'm going to ask us to give the equivalent the same way you sent on. I'll just share a screenshot like this. You see this. So I'm going to ask you to tell me the pip value for the TP, that's take profit. You tell me the take profit pip value. How much am I making when I'm in profit? How much am I making when I'm in loss? You get in pip. You tell me the value. Now you tell me the equivalent of this value in dollars. That's just the simple mathematics we are going to be doing. Just very simple. In you tell me in you send it to that same email you sent it to. So I'll share a screenshot with us. So please, time for questions. If you have any questions, please ask. Any questions, I'll send two screenshots. I'll measure them, I'll name them A and B so you understand. screenshot A, screenshot B. Then I'll send it on the group chat, forward it to my email. Then I'll check it, we'll look at it, then we'll pick up from here with this lot size. Please write this down. Four types of lot sizes: nano, macro, micro, standard. So these are the meaning. Nano lot sizes starts from zero point 0.0, just three decimal places, 123, 123. It starts from 0.001, it ends at 0.009. Anything above this is called macro, where it starts from 0.01, ends at 0.09. Micro starts at 0.1, ends at 0.9. Standard starts one whole numbers, basically from 1 till above, all right? But brokers will not let you to pass 50, so you do not rip them, or you don't ruin them or something, or you don't close them down in one night. So that's it. So next class, this is what we need to download, still part of the assignment. So let me write it down. Assignments. You need to install these apps on your phone. Next time I'll come very prepared. I'll need to test my systems and everything. The Jitsi is working. You can see Jitsi, we're able to have, you can even have three days class here on Jitsi. I've had a 24, almost a 20-hour session, but I slept off shower on GC. The meeting was going on and it didn't end. So I was testing it. So this is the assignment. One, you have to download, install the following apps. So install the following applications. One, Forex Factory. I'll tell you why we need this. Two, I don't know if investment.com now has an app, but check investment.com. If they have an app, please install it. Then any of these, okay, don't worry, let me get there. Install this guy, very important. Then on your desktop, create an account with these people. Create accounts with the following, because I want us to tradingview.com. I'll see you next class. We'll start with it on how to create account. Tradingview.com. Create accounts with baby peeps. I want someone to come out next class. Let's challenge ourselves, because that way too I learn too. I'm not a perfect person, please. All right. So create account with the following: tradingview, babypeeps.com, and if you can create accounts with, just create accounts with any broker. Let me not recommend. Just create accounts with any broker. Just create an account and keep with any broker if it's possible. Then we'll still look at this next class. Then I'll send you other assignment in for us. Remember your system, please. For your system, I need these apps on your system, so that while we're having class like this, if somebody has confusion and cannot share a screen, I can quickly log into your system. Just install Steam Viewer system of here. I can access your phone too, but phone I might not be able to see clearly. You get Team Viewer, but you can have it on your phone. Team Viewer works on phone, so you can install Team Viewer on your phone. For your system, you can have any decks, so I can just access your system or your phone from wherever I am. So it's a virtual tool for remote desktops. All right. So you can install this. Then this one is not compulsory. You can decide to create, but it's compulsory to create an account with TradingView. Very important. Baby Pips is just so that you can read ahead if you have time. Then any broker to make research, anything I've taught, check it. If there's a challenge, write it down. Next class we are going to review it as a team. All right. Yes, please. Are we to install it on our systems? Yes, please. Systems. You can install on systems. For the ones for phone, MT4 is for phone. MT4 is there for system, but please, this app, get it for phone alone. For phone, please. This app is for phone only. What did I do now? So so please, just this one, there's arrow here is for phone. All right. So we have Forex Factory. Forex Factory 2 is for phone. So let me do like this. Okay, I think I know what to do. So anyone you find arrow is for phone. Forex Factory phone. Investment.com phone. All right. So this is it. Once you organize the whole stuff. So the first three for phone, Steam Viewer or any DEX, your system, Trading View, just create an account with them, use their web app and others. So please remember this 10 pips makes $1 and all the lot sizes. Next class we are starting from here. So guys, thank you very much for joining. Thank you for the um, audience and I'm sticking out to you this very moment, like we always say. Trust me, you are embarking on a journey that is going to change your psychological approach on finance and a couple of other stuff. So we need to take serious as this can help us grow. It can help us be more real to ourselves. Be very real to our financial lifestyle too. We now see life differently. So thank you very much for joining in and for your attention and cooperation throughout the class. Please, next class, 7 p.m. is 7 p.m. I might not wait. Today I just decided, okay, let me wait for benefit of doubt. Next class is on Thursday. We voted already. I think Thursday was what we agreed. So on Thursdays is the next class. 7 p.m. is 7 p.m. Then Saturday was the last class, 7 p.m. also. Saturday's class might be from Okay, yeah, Friday I have meetings. Okay, 6. It might be from 6, it might be from 7, it might be from 8 through 10. So it's going to be a 2-hour class on Saturdays. Today is 1 hour. We did 1 hour, 30 minutes because we joined it. So please, that's how it's going to be. So thank you very much for joining. Any question, let's please specify before I close.